Now we're going to talk about the owner's equity section of a classified balance sheet. We already know that the owner's equity section contains the capital at the beginning of the accounting period, the net income or net loss, any money drawn out, which is the owner's drawings, the increase or decrease in the capital based on those above two items, and the capital at the end of the accounting period. This is what it looks like. So in this example, we have R. Miller with the capital at the beginning of the accounting period of $90,680. We then add the net income for November, which is $2,450. Then we subtract any drawings. In this case, the drawings were $1,500. That gives us an increase in capital. We take the net income and we subtract the drawings, and it gives us an increase in capital of $950. We add this $950 to the original capital on November 1st, and we get a total of $91,630 as the capital amount at the end of the accounting period. What do we do when there's a net loss? First of all, in this example, we have capital at the beginning of May of $99,245. The net loss for May was $1,200. We also have drawings of $1,800. These two together, when added, causes a decrease in capital of $3,000. So that amount is subtracted from the original amount of $99,245, and it gives us capital at the end of the accounting period of $96,245. Here's another example. We have net profit and we have a decrease in capital because the drawings are bigger than the profit. In this example, we have net income of $1,000, but we have drawings of $1,800. This means there is a decrease in capital of $800, which is subtracted from the original amount of $99,245, which gives us an amount of $98,445 for the capital at the end of the accounting period. Instead of listing the owner's equity calculations on the balance sheet, we can do something different. This reduces the amount of clutter and complexity in the owner's equity section, and this is called a statement of owner's equity. We can create a separate document that does all the calculations for the owner's equity section, and we can attach it to the balance sheet so we don't have all these line items on the balance sheet itself. This is called a supporting statement, this statement of owner's equity. It provides the owner with data regarding the change of equity during this accounting period, but it's not actually written on the balance sheet itself. Only the owner's equity balance at the end of the accounting period is necessary to be written on the balance sheet itself. So what does this statement of owner's equity look like? Here's an example. Who, what, and when is the heading. Goldman's Gym. It is called a statement of owner's equity, and we use the terminology for the month ended and then the end of the accounting period. Let's look at the difference between the owner's equity with calculations and without calculations on the balance sheet. Here's the balance sheet showing the owner's equity with calculations. So you can see we've got the beginning balance, we've got any net income, we've got any drawings, we have the increase or decrease, and then we have the final amount at the end of the accounting period. Now we can see, if we use a statement of owner's equity, the balance sheet looks much less cluttered down in this area here. All we have, instead of all those calculations, is this one line right here with the amount at the end of the accounting period. And this is what it looks like up close. So we just have this one line right here, R. Miller, capital at the end of the accounting period, and then here's the amount. Now let's talk about another new type of document. This is called a schedule of accounts receivable. This is a supporting schedule, which is simply a list that supports an entry on the main statement. So instead of listing perhaps 5, 10, 20, 100 different types of accounts receivable accounts on the balance sheet, we can create this schedule which supports the accounts receivable amount on our balance sheet. So you can see I've highlighted here accounts receivable of $2,600. Well, this isn't just for one particular account. There could be many accounts that make up this $2,600. It provides the details of all the accounts receivable for a business. And it supports this total that is placed on the balance sheet. In fact, here's what our particular accounts receivable looks like in this example. We have who, what, and when. The who is Goldman's Gym. The what is a schedule of accounts receivable. And the when is at a specific date. So we don't have for the period ended or for the month ended. We just have a particular date. Then we have all the different accounts that total $2,600, which is the amount that is going to be placed on the balance sheet as accounts receivable. The supporting schedule may be prepared whenever an accountant feels that it would provide additional useful information to anyone who is looking at the financial statement. Your assignment today is to complete questions 15 to 17 on the web and complete exercises 6 to 11. Now, exercises 6 to 11 will take considerable time to complete. We'll probably need between 1 and 2 additional periods in order to finish this, and I'll monitor this and let you know when it is due.